Hi, my name is Victor Fung, and this is my presentation for the Private Placement Memorandum, Due Diligence, and Term Sheet Case Study. Okay, so I'm going to go over what a Private Placement Memorandum, or PPM, is. PPM is a method where companies come up with a document when they are in need of capital. With this document, instead of going towards the normal route of going through the SEC completely and doing common shares, PPM does it by handing out private shares. By doing so, the risk is put onto the investors. There is a ease of entrance into the capital market with PPM because the market is going through regulations and barriers of entry with the private equity market. The main investors that PPM deals with are sophisticated investors. These investors are financially savvy investors who knows what they're doing. Alright, so let's go over some regulations. Private placement memorandums does have regulations. They don't necessarily go through the SEC completely, but they go through certain parts of it. From the Securities Act of 1933, after the crashing of the market in 1929, Regulation D happened. Regulation D is something that PPM follows. In Regulation D, there are three rules: Rule 504, 505, and Rule 506. Rule 504 allows all investors to be able to invest. There is an unlimited amount of investors allowed so long as the total investments do not exceed $1 million per year. The issue with this is that the company should create some sort of barrier requirement to ensure that they get quality investors and not just anybody. Rule 505 allows up to $5 million per year, but mainly accredited investors are allowed to invest with the exception of up to 35 non-accredited investors. Accredited investors are considered wealthy people who meet a specific income requirement. Now with Rule 506, there's no limit to the amount of accredited investors, and they also allow up to 35 non-accredited investors, but the non-accredited investors have considered a sophisticated investor. With Rule 506, there is no limit to the amount of money that is invested. Okay, now let's talk about Rule 144A, convertible transactions. They only sell to qualified institutional buyers. These buyers are companies with billions in assets. This type of security is first sold to agents to resell to the qualified institutional buyers. And then there's Regulation S, which allows the private shares to be offered overseas. And then small corporate offering registration, or SCORE, is so that small businesses only have to deal with Regulation D. Alright, so due diligence. What is due diligence? It is the responsibility to do research and be knowledgeable of what you're about to get into. It is the responsibility of both parties to do their homework before agreeing. The Securities Act of 1933. Due diligence became a common practice from the Securities Act of 1933, Section 11. In Section 11, it is called the due diligence defense. This defense allowed a party to say that it was the buyer's responsibility to do their homework before signing the agreement to purchase. This allowed protection to the seller as long as the selling party did in fact have proof that they disclosed their findings to the buyer and the buyer purchased it on their own. Alright, so with due diligence, there are 9 possible areas to focus on to audit. There's legal or environmental, reconciliation, production, financial, management, compatibility, information systems, macro-environmental, or marketing. So let's take some time to talk about the financial audit. Financial due diligence is important because it is the main thing that may block a deal from happening. Some ways to make sure that doesn't happen is by including the goals of financing, what the money is needed for, timetable as to where the money will be at certain times, expected achievements, profitability of the company after the financing, financial forecast for best, worst, and most reasonable case scenario, capital expenditures, how much is used per month, accounting taxes, consultant contracts, and all historic legal issues. Alright, so let's talk about term sheets. What is a term sheet? A term sheet is the documentation that is created as the basic guidelines to the pitch. It is not a legal binding document yet at this stage. This is where negotiations happen, and it is the attempt to come to agreement with one another without having to do all the compromising. This process could take a long duration of time and even several different term sheets. This leads to high expenses from legal fees, but is completely necessary to ensure that they don't get taken advantage of. Think of it as a building block towards a proxy. Once all of these guidelines are agreed upon and signed, the term sheet then becomes a proxy. This proxy is what the lawyers will use to be their guideline in writing the final agreement for the two parties. If both parties decide to then sign that agreement, then at that point the agreement would finally become a final and legal binding document. Alright, so here are some things to keep an eye out for when the lender demands for preferred stock, liquidation rights, high cumulative dividends, reverse vesting, and drag-along rights. When they want to have rights to preferred stock instead of common stock, they want to have more protection. Through a liquidation situation, if the borrowing company ends up needing to liquidate, then the lender's the one to receive the cash from the deal first. When they want to have high dividend yields and cumulative dividends, it is always important to negotiate for a lower rate. With reverse vesting, this usually comes to a surprise to the borrower. What this does is ensure that the borrower will be around the company and can't just walk away from it. The borrower has to earn their common stock shares over a period of time instead of having them right from the get-go. Drag-along rights give shareholders the right to vote upon whether the company gets sold or liquidated, potentially leading to the borrowers receiving nothing. It is very important to hire a good lawyer and negotiate to the best of their ability to make these terms more suitable.